basket weavers who sit and smile and twiddle their thumbs and toes.
You know, you guys are so irreverent. How did I get stuck with these guys? Crying out loud. I'm trying to talk serious with a certified financial planner who actually focuses on baby boomers and what they fear most, Alzheimer's and so forth. Gene Pastula in the house. Hello, Gene. How you doing?
I'm well. How you doing?
I couldn't be better, my friend. Could not be better.
Yeah, I'm very well.
I've been going through 18 reasons Americans are afraid. I heard you and Stuart talking about how you're going to take, a whole week and catch up on your reading. Is that what you said a few minutes ago?
That's what I said, yeah.
Well, this is what I do. I have no life because I read this stuff, and exactly. But every once in a while, there's some pretty good info that I get to share with our audience. I want to go through a couple of these and have you comment on them. It's entitled 18 Reasons Americans Are Afraid to Retire. The first one, people could routinely live past 100, but they might not want to. Just give me a short comment on that.
No kidding. 30 years of doing nothing.
30 years of doing nothing.
Yeah.
And of course, we've been talking about the declination in your mental capabilities is a drag. It's not fun when you are the person that can't remember who your grandkids are.
Right. And then you don't have to cheat your golf score because you just make it up as you go along because you can't remember.
I won't get into the women, the Social Security, or the Gen X, because I know you've got way too. Here you go. Caregivers are facing a retirement crisis. A survey of families with children with special needs found that a large majority, 82%, of caregivers are concerned that they do not have enough financial resources to last their disabled relatives' entire lifetime. Of course, caregiving goes beyond just children, disabled children, and so forth. Almost 9 in 10 caregivers, 87%, are concerned about what will happen to their special needs relative. 59% of caregivers have not taken the basic step of preparing a will. 60% of caregivers with life insurance have less than $300,000 of coverage. And only 23% of caregivers have a former financial plan for their dependent, and only 37% work with a financial advisor. Now, caregivers go beyond dependent children. There are dependent parents and dependent grandparents. This is your field of expertise.
Yeah, well, in fact, I just went through a short experience yesterday on the phone with a couple that had called in and asked for some information and assistance with long-term care planning. And I had, after talking to them, I had sent them an idea that I thought would be, a good balance between using the Link Benefit Life product that we typically, use or recommend, that basically if you don't use the benefits, they'll end up going to your children someday, and that's good. And I gave them an illustration of what I would do in their case, balancing between how much to the kids and how much they would need for long-term care. And their first question to me is, "This isn't enough," and it was.
Wasn't enough for the kids, or was it
no,
enough
it wasn't
for
enough for
themselves?
them.
Really?
Long-term care. And
How much
I
was
said,
it?
Well, it was $250,000 each. $250,000 of benefit that they could tap if they needed it for long-term care, and so that's $500,000 between the two of them.
Can you
do the math?
Can you amalgamate them? Like if one doesn't have a need?
No. This program was $250,000 each. But the interesting thing is, when they objected to it, we started talking. I said, "Wait a minute. Do you have an experience with?" You sound like you have had experience with long-term care. And that's what they told me. Both his father, I think, and her mother had spent a long time in utilizing long-term care. So they were, he said, we still have the scabs, Now,
just statistic, and I hate using statistics because, you could have a problem for 10, 12 years if you have Alzheimer's. But statistically speaking, It's what, 2 years for men and 3 years for women?
Yeah, in that range. Yeah. I mean, typically, I like to see a quarter to $500,000 of value in the whatever long-term care program we're using, the potential benefits that the client can get and feel very comfortable. Now, does that protect them against a long-term lifetime situation? No. But it takes the bulk of the risk off the table, and at a price point that most people that I'm talking to can handle. So, but when you have somebody who's, their number one concern, they call me because they like the idea of the linked benefit program that we've talked about. So that was fine, except that they wanted a lot more than just that much.
Well, let's talk about that for a second, because a lot of people know about the linked benefit plan, as we've talked about it, and it is a pretty amazing product when you think about it, because it is truly what we call in the business an asset transfer. You're not really spending money. You're just transferring assets from one investment account or savings account. I shouldn't say investment.
Well, sometimes it comes from an investment account
to a savings account.
Right.
And that savings account gets leveraged up from $100,000 to $200,000 or $250,000 to $300,000 or $400,000 of potential long-term care benefits. Talk about it.
Yeah, and what we're doing is using a life insurance policy that is the only insurance that is designed and priced with the assumption that a claim is going to be paid, because we still haven't figured out how to get out of this without dying, and life insurance always pays when you die, if it's still in force when that happens. So basically what we've done is with this individual, I literally created a death benefit of life insurance that fit within how they were going to pay for it, and we designed that as well, and how they were going to put money in there every year, and then one or two things would happen, or both, that if they needed convalescent care, they would start receiving money distribution from the life insurance, even though they were still alive.
So the $250,000 death benefit would be reduced.
And they could get up to $10,000 a month of
that
long-term care.
$250,000. So after 25 months, the money's gone.
Exactly. In that particular case, if they lived for 8 months, 9 months under that situation and passed away, then the remainder of the $250,000 would be paid to their heirs. So clearly, whatever they're putting into is going to act like an investment, because it's going to create that $250,000 for somebody.
When we come back, we're going to talk about that return on investment. I also have a few other of these pretty scary statistics with respect to retirement planning to discuss with Mr. Gene Pastula, Certified Financial Planner. Stick around. The Ray Lucia Show continues. We also have emails coming up just ahead. Mr. Stewart is prepping them as I speak. RayLucia.com. Click on the Ask Ray button. Shoot me an email before Pastula shoots me an email. Or shoots me. Not bad. There's no question about it. People are indeed living longer. But still, according to the statistics, men tend to die, and women end up going into nursing homes before they die. Now, that's not 100% true, obviously, because men also go into nursing homes or need care. But statistically speaking, women are at greater risk. So I want to talk to the women that are out there today with Gene Pastula, because many times, Gene, it is the female that needs the care, and in some instances, their husband is already passed when they need the care, and that caregiving is relied upon by, they rely, I should say, on their children or grandchildren to take care of them. But then there's the cost to the children and the grandchildren in terms of their own mental health and their own financial security.
Yeah, I mean, you're right. Statistically, there's more. You go into any nursing home, for example, and you'll see, you say 70% of the people in there are women, and less than half of that number are men. And I don't know whether it's just that women just refuse to die or what it is, but my mother is going to be 94 in a couple of weeks.
I understand she's very depressed.
Yes, she said she was not feeling well this morning because of last night's results, and I called to tell her I was called to gloat, but I'm going over there after the show here and
what was she concerned about?
Oh, I
future?
don't know. The future. Yeah, she was concerned about the future. That's the word she used, and
she's
which
93.
is good. She's 90, almost 94. So
I hope when I'm 94 that I can say I'm concerned about the future. Mm-hmm. That's great.
Yeah,
that's awesome.
I won't dwell on that subject because I get it. I mean, I could go on and on about the conversations we have, but anyway, she's a delightful lady, but. Now, she took care of my father. My father was at home, and for about probably the last 6 or 8 months of his life, he was being cared for by her. And at least 2 out of the 6 activities of daily living. And
your father was a famous war veteran.
I don't know how famous he was, but
they made a movie about him.
Actually, they did, yes.
That's pretty famous.
That's pretty good.
They make a movie about you?
No, not yet.
At least none that you want to admit to.
The insurance business hasn't got to that level of importance, I guess.
We won't talk about the movies they've made about me.
Well, someday you too may have one. In any event, so the whole, you're right. The statistically, that's the important thing to really focus on. We set up people with strategies where both the husband and wife are covered, and with one payment or one deposit or whatever the way we do it. And invariably, I could just tell that both people are thinking, okay, there'll be enough here for Dad because he probably won't last that long, and then the rest will be for Mom, and so people pretty much understand that.
The concept of asset transfer, I think, is excellent because so many people are afraid to spend money. They don't want to bill every single month in retirement. Now, we know that you have to amass a certain amount of money just to cover post-retirement health care expenses. Fidelity tells us like $250,000. You put that on the back burner, and then there's this long-term care cost. Wouldn't it be nice? And you don't have to do the lump sum, do you? I mean, you can fund this over time. So it doesn't matter how old you are. You could be young and put money into this. You could be old, put a lump sum. You can fund it over 5 years, 10 years. But once you do it, that money is there, it's in a reserve account, and you can tap into it if you needed to.
Yeah, for other purposes, yes.
So let's say, just as an example, that I want to do this, and I take $100,000 for me and $100,000 for Jeannie out of our brokerage account, our stock account or whatever. And we now have this, and it translates into $200,000 of death benefit and $400,000 of long-term care benefits.
That's one version, yes.
That's one version.
Right.
And one of my former real estate partners calls me and says, hey, if you guys can come up with 100 G's, you can join in this real estate deal, and we're going to get about a 7-8% cash-on-cash return, and you can leave that asset as a legacy to your kids. Jeannie could take $50,000 out of her account. I could take $50,000 out of my account. And I still have the $200,000 death benefit or the $400,000 long-term
less
care
$50,000.
Less the $50,000 that I used.
Yeah.
So what's not to like about that?
Yeah. No, it's in fact, when we designed this thing 25 years ago, it was in response to the difficulties that we were experiencing with the traditional long-term care policies, and how much benefits there were, and what the price was, and whether the price would go up and the like. And this is basically set up so that you set this up and there are no price increases. It's guaranteed, and the ultimate long-term care benefit or the death benefit is guaranteed. And it operates like good life insurance policies do. It's really the future of insuring or using insurance for long-term care. I think it's the most predictable and dependable approach.
I want to get to one more of these. Half of Americans, they say, are afraid they will outlive their money. I want you to address that as a CFP that helps retirees, pre-retirees, et cetera, with their retirement planning. How are you addressing that particular risk?
There's a gentleman named, his first name is escaping me, you might know it, his last name is Hagna. He's a national expert in the area of annuities.
He wrote a book, it's an orange book. I was on a speaking program. I don't know his first name either.
Yeah.
But he was
Tom Hagna.
Yeah. He was selling his little books. I think it had an orange cover.
Yeah, he's done several of them, and he's a very eloquent speaker on this subject. And he uses the term math and science, And he says, when you're dealing with finance, financial planners, investment advisors, or whatever, they're all providing you with advice based on their experience or their opinions. I mean, because it's all over. What he's doing is using math and science to offer a pension plan that you pay for, but then provides you with a pension for the rest of your life. These are annuities, and the annuity business is going through the roof. And the creativity that the companies are coming forth with to basically allow you to satisfy just about any set of circumstances is just amazing. I have to admit, I'm having trouble keeping up with all the features and the benefits that the variety of products now offer. Fortunately, I have a company with a staff of people who are, that's all they do all day long is pay attention to these. So I just gather the facts and the circumstances and then take it to my associates, and I say, okay, what's the best deal to do this, or what's the best way to accomplish this? But yeah, the annuities that will provide you a place to continue to accumulate money for retirement safely at rates of return that are acceptable, products that will guarantee into the future a specific income to start, which you cannot even begin to guarantee or to expect out of the investment advising situation today. So that's the number one source of a retirement solution for boomers right now. And,
Thank you. You've vamped long enough for me to go to the head and back. Just
glad.
kidding. Gene Pastula, folks. There's nobody better
You told
at
me
this stuff.
you didn't tell me how to be a short answer.
SafeMoneyMonitor.com. This is so important, folks, for you to get a handle on this part of your retirement planning. A lot of people talk investments, what your portfolio is doing today or what it's not doing today. Yeah, that's important, but managing risk is step one in financial planning, and I can think of no greater risk than the risk of dying too soon or living too long and getting sick along the way. And Gene Pastula can help you with all of those. Now, just contact him. Go to SafeMoneyMonitor.com. Give him a call. Have him get you the numbers on it. You will see that it looks a little too good to be true, but take it from me, it is true. SafeMoneyMonitor.com, 800-809-6783. I know, because you helped me write a chapter in one of my first books, very first books on that subject. Gene Pastula, CFP. Emails next.